Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are back on Fed Watch. It's taken us all week to come back around to talking about what has been the overwhelmingly dominant narrative, really, for the past let's call it 2 years, going back to June of 2021, when the Fed finally threw in the towel on inflation is transitory, we don't need to do anything, to actually we need to raise rates aggressively, and that will shape markets for the next 2 years. Thank you very much. So, having spent most of this week looking at other things in a dearth of news flow, we are back to talking about just that story. And of course, the focus is on a speech from Fed Chair Powell tomorrow that will wrap up the week at a time when the markets are looking at the breadth of the news flow and saying, make all of this make sense. What exactly is occurring here? And why are these market dynamics looking the way they are? We, of course, have had over recent days a number of key developments in benchmark markets. So let's go through and see exactly what seems to be occurring, why it seems to be occurring, and then how that calibrates our lens for what Powell might say. Then, of course, what the reaction function could work like in response. So, the first thing that we'll have a look at here is the evolution of Fed policy expectations here over the course of May. And what I have on the screen here in the dark blue there is the expected Fed policy rate in June. In the red, the expected policy rate in December. That's coming directly out of what is currently priced into Fed funds futures markets. So this is not anybody's good idea. This is what the markets are actually pricing in. And then in the gray bars there is the spread. So in other words, what we're looking at there is how much of a rate cut cycle are the markets expecting in the back half of this year. If the rate in June is 5, which is where it currently sits, and the rate in December is somewhere between 4.5, 4.25, well, then where are we in terms of how many cuts we're going to see? And what you notice here over the course of May is that we've gone from somewhere between a 100 to a 75 basis point cutting cycle, so down between 1 and 0.75% at the start of the month. Right here, you can see what's happened now is we've actually erased about 25 basis points of that, a little bit more. And so we're now looking for 50 basis points in cuts. So the market is basically saying the Fed needs to do less easing. Now, the question, of course, would become, why then is this occurring? Why do the markets think that the Fed can afford a shallower amount of rate decreases? Why is it that the markets now think the Fed will ease less than they thought it was going to be the case 2 weeks ago? Well, let's take a look at the dynamics here. And what I've been looking at is the relationship between the stock market and the Fed outlook, as well as the relationship between the dollar, to kind of get a sense for risk on stocks, risk off dollar, assets, stocks, cash, the dollar. And we can see that this relationship has been evolving. So before the SVB-led banking crisis occurred in March and kind of shook up the Etch-a-Sketch on this, what we see from the lead-in, the beginning of the year, is a hawkish turn in the Fed policy outlook. In particular, you can see it really gain momentum in February. So the red line going up, that's where rates are expected to settle by the end of this year, the December Fed funds futures implied rate. When that goes up, you see stocks go down. That's the yellow bars there going lower. The dotted line there is just a moving average to make it a little bit easier to spot what the trend is. So you can clearly see the markets have a risk-off perspective to more Fed tightening. They're essentially saying, you're going to squeeze the economy too much, you're going to introduce too much pain. Once SVB occurs, the situation changes. So you can see policy expectations collapse. You start to price in meaningful cuts. Stocks, of course, go down as well because of the instability. As the crisis starts to wane, stocks come back and essentially end up where they were, around 4,200 on the S&P, before the crisis really struck, and before the Fed rate hike cycle really built up. So they're effectively back to here before this build and before this crash sent them from here to here. So they returned essentially to where they started, but the Fed rate hike outlook never really rebuilt. And what you see subsequently is that stocks and the Fed rate hike outlook are not moving inversely anymore. Now they seem to be moving together. In other words, we are now saying if the Fed outlook is getting more dovish, that's worrying for growth, which is worrying for earnings, which is worrying for stocks. That's a fundamentally different perspective than before SVB. We are no longer saying that the focus for markets is to what extent will the Fed crimp the momentum of an economy that's broadly well supported. Rather, it's more like, to what extent will the business cycle turn sour, and how much cutting will the Fed need to do? It's a fundamental reorientation of the focus in market thinking from how many more hikes to how many incoming cuts. Indeed, this is why the Fed outlook has ostensibly remained lower, whereas stocks have come back to where they started. You can see something similar occurring in the US dollar, where you have a rise in policy expectations giving you a stronger dollar, ostensibly because that improves the dollar's yield appeal. We've said on the show here before that the way currencies work in this sense rests on the logic that one person's higher borrowing cost is another person's greater lending income. And so we end up in a situation where when yields are expected to rise, the holders of dollars can extract a greater income from lending those dollars. It is then a higher yield on the asset of interest, and so people then go and buy dollars because essentially the dollar then yields more than do other currencies in relative terms. Much the same as if a company were to increase dividend yield on its stock. So you can see that as this begins to occur in February, that things build in the rates outlook, the dollar you can see gaining. Then SVB occurs. And you can see the dollar capture its role as a haven. Notice it doesn't begin falling here until the crisis actually bottoms. And then coming out of it, what you see is as rate hike expectations start to cool on this rebuild, the dollar is actually gaining, showing itself to be a haven here. not a creature of yields. This is, of course, that dollar smile relationship that we always talk about, where the dollar does well when business cycle expectations for the U.S. are really good or really bad. Because, of course, if they're bad, that means people cash out. And what is the currency they're going to cash out into? Well, the U.S. dollar is the most liquid. More liquidity means less volatility. If the markets are moving away from volatility in a risk-off, capital preservation first kind of way, well, then avoiding volatility is the thing to do. And so the cash of choice to exit into is the most liquid, the U.S. dollar. So that's where you get this dynamic here. What's interesting about the past several weeks, and really the past few days in particular, is you are now seeing a build in risk, a build in Fed rate hike odds, and a parallel build in the dollar. So ostensibly, it feels like you're back here. And that, of course, speaks to rate cuts evaporating. And so, needless to say, the question then becomes, is something occurring in the economy that it is reaccelerating? Has the fundamental business cycle perspective changed? Are the markets now seeing a more optimistic view on growth? And should that be something that positively impacts risk in a more lasting way? Are we now going to see a repeat of this sort of positive pro-growth story we've seen in markets before, where stocks go up, rates go up, the dollar goes up, because whatever bad things were in the water before, now they appear to have dissipated? Well, not so fast. Let's take a look at what's actually driving these rates and what's driving inflation and expectations, to see what's seemingly occurring in markets actually. There's the current Fed funds rate in the 5 to 5.25 range. The outlook, even with the recent increase, that of course consistent with rate cuts going away, not rate hikes going in the Fed outlook, looking out 12 months forward, we can see that indeed there is a bit of a pickup in inflation. This is the 2-year break even. That's the measure of inflation expectations as it is implied in bond markets. That's the difference between nominal and real rates. Real rates are the TIPS yields that are adjusted for inflation. So if you take the difference between the yields, what you're left with as residual is the magnitude of that inflation adjustment. So you get the bond market's actual priced in inflation rate looking out directly toward the end of the Fed's policy window 2 years out. So you can see here a bit of a pickup. A few days ago, we were actually a little bit sub 2%. So ostensibly, the markets are believing that the Fed is going to be successful, that they're going to bring inflation back to target. Over recent days, gotten a little bit off that, a little bit higher, and that's been consistent with some of these cuts coming off the board. But we are still looking at about 100 to 125 basis points in cuts. The rate range is still 5 to 5.25 now. And at 4.8, we see rates at the end of the year in the 4 to 4.25 range, closer to 4. So what we're looking at then is still, give or take, 100 basis points in cuts. So we are still looking at markets calibrating for, seemingly, economic down to turn, or at least some variety of disinflation. Obviously, here we are currently at much higher levels than 2. But there does appear to be a shift. Now, if we look at where inflation is coming from, just to confirm that it is in fact a growth story that we're looking at, here's a gut check of that transitory inflation bit that the Fed was so optimistic about before the middle of 2021. There was a big narrative out there. We've talked about it here extensively, that inflation comes in 2 parts. There's the sticky part and the transitory part, and it looks like the Fed overestimated how much we have of the latter and not enough for how much we have of the former. But here's the transitory part. You can see here that growth rates in input prices for distribution services, this is shipping, delivery, logistics, et cetera, all of those things that introduced inflation because they were disrupted by uneven reopening from COVID lockdowns around the world, disrupted because of the U.S.-China trade war, and introducing inflation just because the cost of doing business went up. We can see that that component of input prices for businesses has essentially stopped growing. The growth rate has collapsed for both final and intermediate goods to essentially 0. You can see that with the dark line here for final goods, the red line here for intermediate goods. So the inflation that is there to be had from shipping disruptions, supply chains issues, that's ostensibly off the table as an inflation driver. You wouldn't, of course, expect them to be 0 completely. In fact, you can see they average meaningfully above 0 before COVID. Shipping, of course, doesn't cost anything like it did at the height of the crisis, but it does cost more than 0. And so you can see here the Baltic Dry Index. This is a benchmark for global seaborne shipping cost. That has come in significantly and is now right around the averages that persisted before COVID. So ostensibly, the transitory part of inflation is not why this perk up in both inflation expectations and rates is occurring. That, of course, is something of a knock against the rosy growth narrative. Because if, in fact, this was about supply chains getting squeezed again because demand was improving, we would see these values going the other way. And we very plainly don't. Instead, we can see that inflation now seems to be getting squeezed out through economic slowdown. This is a chart we've looked at quite a few times. This is the mismatch between labor supply and demand. We can see that during COVID, there was a surge in supply relative to demand, and that's why we have this jump right here, which, as you can see, drives inflation aggressively lower. In the red is CPI, in the orange is PCE. As the crisis starts to abate, we start to get reopening, people start coming back to work, this mismatch erodes and actually flips very much the other way, where there is a lot of demand for labor, but there is under supply. And so then we are ending up in a situation where inflation is being fed by this mismatch. We can see that occurring right here. Now, most recently, we can see over the past 4 months or so, this mismatch is getting squeezed out. In fact, we are, as of the latest jobs report that we just saw at the top of this month, at the lowest shortfall in the labor market in almost 2 years, going back to September of 2021. So this is now a situation where inflation isn't being squeezed down, broadly speaking, because supply chains are being mended. The dividend that was to be had there is already realized. That's ostensibly how we got from 9% inflation to 5%. What's going on now is we're starting to squeeze growth itself. The cumulative impact of Fed policy is now to actually decelerate the economy. And it's starting to show up in the laggiest of all markets, the labor market, already at this point. You can see that show up in the latest consumer confidence numbers. Consumers getting increasingly pessimistic here, and of course, consumers are how the U.S. economy grows. They are also how the global economy grows. The U.S. household consumer contribution to U.S. GDP is close to 75%. Its contribution to global GDP amounts to 16% of overall global output. And so we're looking at something that is quintessential for U.S. growth, certainly, but quintessential for global growth at the same time. So it is, in fact, the case that the economy is being squeezed. We can see it in the way that economic data in the U.S. has been performing relative to expectations. It has quite clearly been deteriorating in recent weeks. So as we look at yields going up, as we look at stocks going up, as we look at the Fed policy outlook getting better, or at least more hawkish, let's say, the question naturally comes, well, is that because of a positive turn in the business cycle? Doesn't seem to be. On the contrary, it seems like we see evidence of economic data looking sour and the effects of the Fed's tightening continuing to wash through the markets. In fact, if we were to take a catch-all of this is that same 2-year break-even in the yellow, overlaid with inflation. You can see it tends to lead inflation by about 2 months. And what that's telling us is that we are going to about 2% inflation over these next 2 years. We saw in the data just now that the way to get there at this point is not through efficiency gains, it's through economic slowdown. And so what we then have to surmise is that the markets are already pricing in about 2 years of economic pain. So looking then at the way that this is developing becomes quite interesting because, again, here we are in an environment where the Fed outlook is getting a little bit less dovish and risk is getting a little bit firmer, and the dollar is getting a little bit firmer all at the same time. How this then reconciles with the larger environment seems to be that over the past several weeks, we've been really focused on this U.S. debt ceiling situation. And of course, much has been made around the idea that what we're risking is default, but that seems a bit silly. You can't price in a U.S. default into financial markets, which have as their risk-free asset the U.S. Treasury bond, and which have as the global medium of exchange, without any sort of dispute whatsoever, as the U.S. dollar. Consider that the latest numbers from the Bank of International Settlements suggest the dollar is 88% of global monetary transactions, and that share has not declined in years. So what we're looking at then is a financial system which depends as foundational conditions on the idea that the U.S. can pay its debts, because you can't have the U.S. government debt instrument be the risk-free asset, and you can't have the dollar be the transactional currency and then have a U.S. default. If that were to happen, the bedrock of the global financial system as it exists today would suddenly vanish. So naturally, you can't take the system as given and price that outcome. The system wouldn't exist as given if that outcome were to occur. So instead, it seems what the markets have been doing with this debt ceiling situation is speculating on the degree to which it will be a fiscal headwind. If a deal doesn't get done on time, how long will we have to wait for policymakers to negotiate? How much government spending will be sidelined during that time? And what kind of a hit to growth will that be at a time when the economy is already absorbing a good deal of monetary tightening? And will continue to for some months yet. Indeed, that's how, ostensibly, this entire relationship is supposed to work. That's how you get from 2%, or rather to 2% from 4 or 5% inflation, depending on whether you look at CPI or PCE. Because economic slowdown will continue, because Fed monetary tightening will continue to be absorbed. So then any amount of fiscal tightening on top is, of course, unwelcome. What it looks like now is the recent positive squawking that we've seen out of both the White House and the Republican House of Representatives leadership, suggesting that nobody is interested in a default, that a deal will get done, that it will be finalized in time most likely, but that negotiations are now taking a much more constructive turn. We're seeing, it seems, the risk of that fiscal tightening being a big disruptive thing getting factored out of markets. And so what we have is a temporary sort of benefit to the cyclical story, which is how you get Fed rate cut odds being reduced, as we see here, and yet risk taking that as good news and the dollar taking it as good news at the same time. The problem, of course, is that we are still left with this. To get to 2% inflation, the market thinks the economic environment will be difficult enough that we'll need cuts. Because as you can see, the 12-month orange line is well below where the current range is. And so the upshot then seems to be that this is not a lasting risk-on story. Because if it were, then inflation would creep higher, and the Fed would have to act harder, and we'd be right back to where we were in February. And if this is but a short-term blip in an otherwise risk-off story, well then the dividends that we're seeing added back into risky asset valuations should deflate again. This, of course, sets us up for the speech from Chair Powell, because he holds the opportunity to pour cold water on all of this development. We've heard from the Fed chair incessantly in recent weeks that the Fed is not looking at rate cuts. Nevertheless, the market is at this point still baking in some. Less than before, but some. If the Fed chair comes out and says, it looks like we can pause here, or at least hints at it, doubtful that the Fed chair is going to paint himself into a corner by being overly specific, but if the message seems to be we are mindful of the cumulative effects of monetary policy. We are focused on inflation. We welcome that the fiscal side of things seems to be getting a little bit less acrimonious and a little bit more clear. And if we need to raise rates, we will. That would send a message to the market saying, if you keep going with this narrative, if you take the removal of the debt ceiling as a cyclical headwind off the table and ignore what else is going on and run with that, inflation expectations are going to go up and the Fed is going to have to fight it. If, on the other hand, the message from the Fed is somehow a change of course and it starts to sound a little bit softer, then perhaps you get a little bit more of a tailwind, because if you then have a reduction in Fed policy odds and a few more cuts get baked in, well, then perhaps risk sentiment has the best of all possible worlds. A reduced fiscal headwind that you don't have to pay for with an increased monetary one. But so far, that's exactly what we're looking at here near term. And if the Fed chair comes out and tells us, yeah, if these inflation expectations keep getting driven higher, we're going to respond. We are by no means committing not to respond at this point. Well, then risk might crumble, and we might get back into the dynamic that we saw in February much more clearly, whereby the dollar is stronger as Fed rate hike odds change in a more hawkish direction, but risk falters. And so some of these recent moves that we've seen in stock markets might not have very much leg to them, whereas the dollar might only be getting started on its march higher. Therein, we'll have to see what the price action response is to what Chair Powell says and what investors choose to pull out of the comments to respond to, which will hopefully help to set the lens for markets for how to interpret incoming news flow after the speech versus before, to see if these dynamics hold or if a different regime is in fact in the offing. That, of course, will shape how markets work for at least the next week, but perhaps a few more yet to come. And that wraps up macro money for today and for this week. We are here Monday through Thursday every week, right after overtime with friend of the show, Chris Vecchio, where we discuss the preceding day's events across global financial markets and try to make sense of what's going on. I'm also on with Chris for Futures Power Hour on Friday. I'll be there tomorrow. And then on with Tom and Tony for First Call Sunday evenings as markets come alive in Asia Pacific trade for the week. Outside of those shows, I'm opining on Twitter at Ilias Pivak. Thanks very much for joining, everybody. Happy trading out there. See you soon. Take care.